Now in this video, I'm going to be sharing the 4 main types of market environment that we've seen historically, but then also explaining which of the Stockspot investment assets performs best historically in that market environment, which will help you understand why we're diversified across different assets, because it allows you to take advantage of different types of market environment. The first type of market is an inflationary boom. This is characterized by a positive market environment, positive growth, and also upward trending inflation. It's something that we saw in the post-war era in the 1940s and 1950s, and then again in the early 2000s. The types of assets that tend to do well in this type of environment are commodities, but also emerging market shares. And that's why in the early 2000s, we saw the emerging markets, share markets, as well as the relevant ETFs do very well compared to more developed markets. The next market environment is a deflationary boom. This is a period where economic growth is strong, but there isn't a lot of inflationary pressure. This market environment is something that we saw, for instance, in the 2010s or 1990s. And the sectors that tend to do really well are long-term growth sectors like technology. And that's why the US share market has tended to do very well in these periods. It did exceptionally well in the 90s, and again, after the market crisis in 2008, in the 2010s, US market did well. That's because US shares tend to do well in a deflationary environment, and that's when our Global 100 ETF has also performed very well. The next one is stagflation. Now, we haven't seen this really for quite a while, not since the 1970s, but it's a period characterized by rising inflation and poor or weak growth. This is a very difficult market because it tends to lead to most share markets and bond markets performing badly at the same time. But the asset that tends to do very well in a stagflationary environment is gold. And this is one of the reasons why we have a relatively high allocation to gold compared to a lot of traditional fund managers in the Stockspot portfolios, because in a stagflationary environment, it will be the asset that you're likely to be relying on to generate returns within your portfolio. And the last type of market environment that I wanted to talk about is a deflationary bust. This is where we see both weak inflation and weak growth at the same time. Some famous examples include the 2008 financial crisis, but also the Great Depression in the late 1920s and early 1930s. This is a very, very difficult market, and one that central banks and governments really try and avoid because it can lead to a big catastrophe in an economy. This is something that we haven't seen since 2008, but when those types of periods come along, generally government bonds are the asset that you want to be in, because interest rates need to be cut in order to really reinvigorate growth and economic activity. And this is why government bonds haven't performed too well since that crisis in 2008, because we haven't seen another deflationary bust around the world. But this is why in the Stockspot portfolios you own a range of assets, because we need to be able to have an asset that's doing well in different types of market environment. But it also explains why these assets aren't always performing at the same rate, because as markets change and as they shift color, different assets are going to perform well and perform not as well. And that's just a normal part of investing in a diversified way.